Okay, time is up. Please bring your quizzes down. Since yeah, don't worry about it. Throw it away. Bring your quizzes down, please. Yeah. What was the email applied? Okay. What was it that you asked me to do? I haven't even looked at my emails are piled up today. Yeah. Been teaching all day. So you didn't do the quiz? Or you did do the quiz? Okay. Yeah. If you did all three quizzes, your worst quiz will automatically get weighted less. Did you miss the first quiz? Okay. And the promise, this quiz will count. Yeah. Okay, time is up. Please bring it down. It's right or wrong, then basically the promise I can't give you partial credit. So I'll give you whatever I can. Right? Okay, time is up. Please bring your quizzes in. Please bring your quizzes in. Time is up. Don't worry about it. Throw them into recycling. And don't put it face down. Make it more difficult to sort. So time is up. Okay, folks. If you're still writing, time is up. Bring your, don't put it face down. Don't put it face down. Put it face up right on top. Okay. Time is up. You're okay. Over. Okay, folks. Get settled in. Time is up. Please put it down. Don't put it face down. Okay. So there'll be people coming in from the other class. So let me at least set the stage. Okay. So last Wednesday, after I finished teaching your class, I went to JFK Airport. I took the A train. No, it takes forever. Got to JFK Airport and folks, the quiz is done. No point talking about it. It's over. Okay. What? It happens every time, so it's natural. But okay, folks, settle in, please. Quiz is over. If you want to talk about the quiz, please leave the room. Hey, guys at the back. If you want to talk about the quiz, you can leave the room if you want. But if you want to stay in. So last Wednesday, after I finished teaching this class, I took the A train to JFK Airport. I got on the flight. And while I was sitting waiting for the plane to take off, I was breaking the rules and checking my iPhone still, not in airplane mode. And I was checking the Yankee game, to be quite honest. It's in process, and I said, will they win? Will they not? And of course, I got the news story coming in as I was checking the Yankee game. About the tariffs, right? Let's face it, we have no choice but to talk about the tariffs. So I spent Saturday on the flight back. I was looking at evaluation projects and get a chance. Sunday all day I was graded. Then I At office hours at 6 o'clock, when I finished with my office hours for the quiz, I started writing about what I thought about what had happened over the week. Okay? So Jake, help me out here. There was a tariff announcement on Wednesday. I mean, we've been talking about tariffs all year, right? So what made this tariff announcement so shocking to markets? Clearly markets were shocked. So what is it about the tariff? Go ahead. Okay, first, magnitude, right? People are expecting so. Second, no, we'll come to that, but it was breadth. I mean, take a look at the map, right? You're saying, but the parts of the map that are not covered, you know, the parts that are not covered, North America, where you have Mexico and Canada, which have had a different set of tariffs, and of course, Russia and North Korea, which are technically under sanctions, so the tariffs wouldn't. So it was the breadth and the depth, and of course, the basis for the tariffs. Sophia, what was the basis for the tariffs? It's basically trade deficits, right? It wasn't a. The reason that matters is there's no easy walking it back, right? If it were based on tariffs, then the other country can say, I'm dropping tariffs to zero. The EU today offered to drop tariffs to zero. Vietnam has offered to drop tariffs to zero. But dropping tariffs to zero is not going to make the trade balance go away. It's a trade deficit that's scaled on a percentage basis, which means smaller countries are going to have bigger percentage. Vietnam will have a much bigger trade deficit on a percentage basis. So the market got a hit, right? It had a pretty good Monday, Tuesday, Wednesday. And of course, you wake up on Thursday and the bottom falls out. So this is the S&P, the Dow, and the NASDAQ all had a pretty bad 2 days. The NASDAQ was down 10%, the S&P down 9%, the Dow down 8%. So across the board. The problem with indices is you look at subsets of companies, 30, 500, even the NASDAQ. So during COVID, one of the things I started doing every week was downloading the market cap for every publicly traded company so I could aggregate and look at the numbers. Right? So that's what I did on my, as I got on my flight to come back, I said, you know what, I'm going to download the data of every publicly traded company. And here's what the numbers look like globally, right? The US had a bad 2 days, but so did much of the world. In fact, the part of the world that had the worst 2 days was what I call small Asia. The small is probably a misnomer. It's Asia without India, China, and Japan. It's the rest of Asia, which would be Southeast Asia, Pakistan. So basically, it's Thailand, Indonesia, down 12.61%. The US was next. And if you look at the two markets that actually had the best 2 days was China and India, but that's a little misleading. Why? There's a simpler date time issue that comes in, which is those markets closed by the time Friday's markets opened up in the US and went through the day. India and China had already closed down. The market's already closed down, which means that if you're going to see an effect, it'll be when you open on Monday. I haven't quite looked because I've been busy all day. I'm pretty sure that they probably opened on a down note today, kind of catching up. There's a lagged effect. So this is across the globe. So I wanted to slice and dice the data to see if this was panic selling. So if this is panic selling, what would I see in the data? Where would I see it in the data? What kinds of companies should go down the least? What kinds of companies should go up the most or go down the most? Anybody want to give that a shot? If it's panic selling, what should you expect to see? It's not even because at this point, people are not even thinking discretionary, non-discretionary, but you're right, that is going to be part of it. But you should see a flight from risky companies, young companies, high PE companies, growth companies to safer companies, right? Flight to safety. So here's the first thing I did. I looked by sector. So I'm going to focus just on US companies because Thursday and Friday were more complete for them. I'll do this on a global basis as we go along. So by sector. Worst sector, no surprise, it's actually energy. Why? Because oil prices were down a lot. The next worst was technology. And if you look at dollar value, it's no contest. Technology alone lost $1.8 trillion in market cap last week, all of it on Thursday and Friday. So across the board, the sector that did the best, and this is slightly supportive of a safety hypothesis, was utilities, down 4.4%. Everything was down, but utilities were down less than most of the market. Collectively, U.S. equities lost $5.3 trillion last week, all of it on Thursday and Friday. Where did it go? You wondered when the market drops, where does the money go? I would love that to be true. Where? How does the government collect the drop in the money? That'd be great if you could, because that'll make our deficits go away in a hurry, right? What happens to it, William? It just disappears into thin air. Remember, we talked about what markets do, assess a value for future growth. They put that into it basically disappears, which is the scariest part of this. $5.3 trillion just evaporated over those 2 days. So don't think of this as people cashing out and moving the money. It's just not that. It's gone. I also then looked at whether the damage was greater at small cap versus large cap, because if it's truly panic selling, you should probably see small caps punish more. There's really no difference. It looks like across the board, across market cap classes, it's 9.51 versus 9. That's statistically pretty much the same number. There is some evidence of safety when you look at companies broken down by PE ratio. So I looked at classified every company into 10 deciles based on PE ratio. The lowest PE stocks were down 8%. The highest PE were down 11%. So not a huge shift, but it can see that lower PE stocks held their value better than higher PE stocks. But let's stay on the safety theme, right? If safety is what's driving it, companies with a lot of debt should have gone down more than companies which have less debt, right? Turns out that the reverse was true the 2 days. Maybe because of the technology overlay, companies with the least debt actually dropped by 9%. Companies with the most debt were down only 8%. Again, not a huge difference, but you're not. So if there's a panic story here, it's kind of a blurry story because there's some evidence in support of it, some not. In fact, when I broke companies down to dividend paying and non-dividend paying companies, dividend paying companies actually went down by about 9%. Non-dividend paying companies went down by 10%. Again, the difference is pretty small. Okay? I mean, I'll gather all the data together, but you're not getting huge divergences like you did in 2020 between different groups of stocks. And finally, the question I asked was, maybe this is just, correction of overpricing last year. If that is the case, what should you expect to see? The stocks went up the most last year should be the ones that get marked down the most. So I classified stocks based on momentum. Momentum defined as what did they do last year. So the bottom decile of the stocks that did the worst in 2024, the top decile stocks that did the best, look at the last column, right? The stocks that did the best did actually have the worst few days, but collectively, not a huge difference again. So was there a flight to safety last week? Yes. Was there some panic selling? Probably, especially on Friday. But this doesn't look to me like what you would expect with a true panic selling, where effectively you leave risky stocks and you go to at least, it's only 2 days in, so we don't know how it will play out. I did look at the Mag 7. Why? Because they've taken over the market, right? And I owned all 7 of them at the start of this year. Tesla, I left early in the year. NVIDIA, I have a quarter of what I own. The remaining 5 are in my portfolio. So this is purely selfish. The Mag 7, just those 7 companies lost $1.56 trillion in market cap last week. Let the numbers roll around. 1.56 trillion gone in 1 week. And it came after they lost 2.6 trillion leading into the week. So collectively this year, the Mag 7 have lost 4.1 trillion. But last week, they looked very much like the rest of the market. Leading in, they look worse than the rest of the market. But the equity market. Are only equity markets affected by a crisis? What is if there is cash in your portfolio, if you do get cash from selling stocks, which is a lot less than what you see as the original market cap, where does it go? Someplace safe, right? And for better or worse, historically, that place has been US Treasuries. So in most crises, what should you expect to see? Cash coming into US Treasuries, and if they come in, yields should drop. So I looked across the spectrum, and again, the backing for the flight to safety becomes pretty weak because if you look at the T-bill rate, it decreased by 0.05%. Even at the longer spectrums, 0.2, 0.25, 0.3%. So there was cash coming in, but not such large amounts that you saw a major shift down in rates. So and I did pick three very odd bedfellows to look as my last table: oil, gold, and Bitcoin. Each is standing in for something. What's oil standing in for? Commodity prices, right? And why do we care about commodity prices? Because markets use that as a reflection of what they think is going to happen to the real economy. Oil prices were down 14% last week. So better or worse, investors are expecting a slowing of the global economy. Gold, of course, is a collectible of really long standing. And the reason you look at it is hey, you want to get a sense of, is this truly a crisis where you're running for safety? Because if you're running for safety, gold should go up. Gold did not go up, but it held its own. It was down only 1.5%. And I was surprised by Bitcoin because through its history, what's Bitcoin done when there's a market crisis? That's not what's true. That's what the Bitcoin people would like you to believe. During a crisis, you'd like it to, right? Okay. The first quarter of 2020. Remember the COVID crisis? Stocks were down 33%. Awful crisis. Gold was up 6%. You know what Bitcoin did in that first quarter? It was down 57%. Between March and September, stocks come back 45%, Bitcoin was up 70%. You can go back and look at every crisis in the last 15 years, and every crisis, Bitcoin has behaved like very risky stock, which undercuts the whole idea of Bitcoin is where I'm going to go in a crisis because, I don't trust anybody. Yes, Sophia? Yeah, there's an interesting question of what this is the first crisis that I've tracked in the last 15 years where Bitcoin has actually gone up. Maybe this is the start of a new dawn for Bitcoin advocates. You're going to become the millennial gold finally that you've been praying you can become. But it's early in the game. Let's see how this plays out because I think this morning Bitcoin was down $7,000. So let's hold off. It might be a little too early to pass judgment on it. But I would track that because if Bitcoin is going to hold up as a collectible, it's precisely for times like this. And if it doesn't work now, then what the heck are we paying $90,000 for Bitcoin for if it's not a good currency and it's not a good collectible? So if I were to summarize based on the data what I see selling. Obviously, everybody sees selling. Prices are down. I don't see much evidence of this being, while panic might have been some factor, it seems to be more like a marking down of equities, saying equities are worth less now after this new story than before. It's more of an orderly retreat so far, at least. And of course, that could change. So that's where we are. So anytime you're in a crisis, you get caught up in this, what do we do now? So what I'd like to do is take a step back and think about how crises play out. Right? So I'm going to draw a picture of what I see during a crisis. Every crisis, there's usually a trigger event, something, an economic, a political, a financial event that starts the ball rolling. I'll give you a couple of examples as we go through. You're investors, the trigger event happens. What's the only thing you control as an investor? What you do, which you can buy or sell, you affect the price, right? And if you're getting scared, what do? You lower the price, which is essentially a higher price for risk. Your risk premium goes up. So the immediate aftermath, investors mark down risky assets, put their cash into something safer. And then the aftershocks begin. What are the aftershocks? The trigger event creates other events. Right? Counter events, events counter to counter events. Market drops create their own dynamic. When markets drop, if you're a levered investor, what do you have to do? you've got to sell to get your cash back because you got to pay the debt. So market downturns create this trickle effect where they play out. So the aftershocks, like an earthquake, the aftershocks continue for weeks after the trigger event, which means and those aftershocks can be positive or negative, right? This morning there was a rumor. You see that the tariffs might be completely made up. Stocks added 4 trillion in market cap, 4 trillion on the rumor. They gave it all up. Get used to volatility because that comes in the aftershocks. Eventually, does this kind of play out in the real economy? Yeah. Why? Because consumers get scared, businesses get scared. Economic growth slows down. So there's a real effect, there's an effect on the real economy in the near term. Could it affect your long-term prospects as an economy as well? Depends on the trigger event, right? It could change economic dynamics, real growth and inflation in the long term, which then feeds back. So it sounds abstract, but let me take 2 crises and trace you through the consequences. Okay? Let's take the 2008 crisis, triggered by the collapse of Lehman Brothers on September 13th and 14th, a weekend, leading into Monday, September 15th. If you read the, the, the book Series of Unfortunate Events, usually before the trigger event, there are a series of unfortunate events where you look the other way. I mean, this wasn't a complete surprise. Bear Stearns had been in trouble earlier. Housing prices looked shaky. But this was the seminal event. You had Lehman fall. The markets go into free fall. In the 2 weeks after the Lehman collapse, stocks lose about 12% of their value. Treasury rates drop. But it doesn't stop after 2 weeks. It continues. In fact, by the time you get to the end of 2008, stocks had lost about 28% of their value, and treasury rates had gone from 3.72% to 2.21%. What were the aftershocks there? I was around in 2000. I was teaching this class in 2008. I remember week to week there were rumors of, hey, Morgan Stanley might go under, Goldman Sachs might go under, Citigroup might go under. Luckily, it didn't happen, but there were these aftershocks that played through. Hedge funds were shutting down because they had fund flows that were so strongly out of the funds, they could not essentially sell to keep up. Money market funds broke the buck. You know what that means, right? You put 100,000 in money market funds, even if you don't make any money, what do you think? I'm going to get my money back. In 2008, you put 100,000 in, there were weeks during that crisis where you're getting 98,000 back. GE, at that time leading commercial paper issuer in the country, could not find people to buy commercial paper. It played out in the real economy. You went into recession. And by itself, you're saying, why do I care as an investor? Because recessions, a slowing of growth translates into earnings, and the S&P 500's earnings dropped by 40%. That's a short-term effect. But this crisis had long-term consequences where banks stopped lending. It took 5 years for S&P 500's earnings to come back to what they were pre-2008. The 2008 crisis had long-term consequences, and one of the consequences was we lost trust collectively in institutions and governments. It's a 2008 crisis. On September 12th of 2008, I started a process that in hindsight I wished I hadn't. I started estimating the equity risk premium every day. So every morning I'd wake up, it's a depressing thought, but I'd compute the implied equity risk premium based on the closing price the previous day. Why? It's the only way I could keep my sanity, because you listen to the voices around you. They're going to tell you, sell now, buy now. It's all over the place. So there's the equity risk premium on September 12th of 2008. There's the equity risk premium on November 21st of 2008, hit 8%. This is the equity risk premium for the S&P 500. That's what a crisis does. The price of risk essentially takes off. By the end of the year, equity risk premiums were at 6.43%, about 2% plus higher than they were at the start of the year. And you know what? Equity risk premiums did not go back to pre-2008 levels until last year. 16 years it took to get back. So this was a crisis with both short-term and long-term effects. Let's take a crisis that's more recent that you remember, perhaps not in the financial market sense, but in a personal sense. February 14th of 2020. You know what the news story was that triggered this whole process? There's a news story from Italy saying that they discovered multiple COVID cases in Italy without any connections to China or cruise ships. Because until that day, the delusion was if you weren't in China or weren't on a cruise ship, then the pandemic wouldn't come for you. And over the next few weeks, you saw the market melt down. In the first week, too, again, you saw 10, 12%. But by the time this was done, on March 23rd of 2020, which is what, less than 6 weeks after that first date, stocks had collectively lost a third of their value, 33%. The T-bond rate, which had come in pretty low to begin with, 1.62%, had dropped to 0.76% by the time you get to March 23rd. Were there aftershocks? In the case of COVID, what were the aftershocks? News about health scares across the country, as well as news about businesses that might not be able to make it because they were shut down, they couldn't pay their employees. Boeing was rumored to be in bankruptcy by the time you got to the middle of March of 2020. Was it a real effect? In the short term, yes. The economy went into recession. If you remember, the unemployment rate exceeded 20% in May or June, though it's not even clear what that unemployment rate even measures if nobody's actually opened up. But here was the difference between 2008 and 2020. By September of 2020, so the earnings dropped for that second quarter, but by the end of the year, it's almost like nothing had happened because the economy came back, the unemployment rate started, it finally got down to 2021, but it started moving down. But this was a crisis that unwound very quickly. And you look back and say, but it was probably helped by the fact that it had multi-trillion-dollar government funding for people who didn't have jobs, and a central bank that was very activist, but for better or worse, it unwound very quickly. So there again, I did what I did in 2008. I computed the equity risk premium every day. There's at the start of COVID, March 23rd, it hits close to 8%, 7.8%. And then by September, it's back to where it was before the crisis. Price of risk shoots up during a crisis, and in this case, it very quickly went back down. Now, whenever you have a crisis, people read too much into it. They, in fact, draw all the wrong lessons because they look at the crisis and they draw lessons. When you look at those two charts as an investor, what's the lesson you draw if you're an optimist? That markets go down, but they eventually return. So if you're a contrarian investor with a long-term time horizon, what will you be doing right now? You'll be putting buy orders like they were going out of style, saying, look, I know my history. But the fact that a catastrophe did not happen doesn't mean that the probability of a catastrophe happening was zero all the way through. Do you see what I'm saying? The fact that we came out of 2008 intact was not guaranteed in October and November. In fact, if Morgan Stanley had gone bankrupt as well, followed by Goldman Sachs and Citi, you'd have had bank after bank failing. You'd essentially have gone into financial hell. It didn't happen, thank God, but the fact that it didn't happen doesn't mean that it couldn't have happened. Could COVID have evolved in a much more damaging way? Yeah. The fact that it did not doesn't mean it could not. So from an investor perspective, don't look at those graphs and say, that means I'll just go buy these stocks because of the tariff, and they're going to always come back, because there's always that possibility of a catastrophic event. When regulators look at crises, what are they trying to do? They're trying to figure out what they can do to prevent the next crisis, right? They're looking for people to blame, people to hold accountable, passing laws and regulations to stop it. So after the 2008 crisis, banks were restricted from risky activities because they were viewed as behaving badly. Ratings agencies had new rules put on them to get... But the problem is you're dealing with a symptom. The incentives that led banks and ratings agencies to do what they did never got fixed. But regulators think if you fix the symptoms, the problem goes away. And of course, researchers go crazy after crises. Because with the benefit of hindsight, what do they say? If you're a behavioral economist, you point to a crisis and say, look, these are irrational investors. Look what they did. Look at the correction. If you're an efficient market person, you look at the same data and say, look how amazing the market is and managed to find its way back. But remember in statistics what you should not do with a sample size of one? Don't extrapolate too much. Every crisis is different. And I'm not sure, I think the mistake we make is we overlearn from past crises. We read too much into the tea leaves, when in fact you should step back. There are things to learn, but you need to know when to stop. So let's look at where we are on the tariff crisis. What was the trigger? The Wednesday announcement, right? That was the trigger. Thursday and Friday is the first phase. But if history is any guide, what does it tell you? The next few weeks are going to be rocky, right? They're going to be, and they get used to plus 1,000 days, minus 1,000 days on the Dow, right? Because that's the nature of volatility. When you're at 32,000, 33, 34,000, okay? You're going to get a lot of aftershocks. They're going to be positive aftershocks with some country. Today I read the news story after markets close that Japan might come to an agreement with the US about tariffs and markets might react positively. 15 minutes later, you're going to get another news story about another country putting extra tariffs on it. Markets will go down. This is the nature of the aftershocks. The probability of recession, which was, I think, estimated to be 20% on Wednesday, by Friday had been up to 50% by, I think, JP Morgan's most recent estimate. So clearly people are estimating a greater chance of a recession. Doesn't mean they know what they're talking about, but clearly people are much more concerned about real economic growth. If there is a positive coming out of this, is inflation, which has been at the center of the universe for the last 3 years. The positive, the economy is slowing. I know there's going to be a one-time jump if tariffs kick in on the price, but that's, that it might actually make the inflation threat dissipate or at least go into the background. What about the long-term implications? Don? First, is global trade good for global growth or bad for growth? Let's, without bringing, clearly they've been good for growth, right? I mean, it's Econ 101, right? So basically. So if you put restrictions on global trade, whatever those restrictions are, by definition, the global economic pie is going to grow slower. It's going to get smaller. And the US economy as the largest piece of that pie is also going to get smaller. You think this is a slam dunk, then why do it? Because you could change the way the pie is apportioned, because that might be the other consequence. For the last 40 years, that pie has gone disproportionately to capital providers. What am I talking about? Equity market investors have clearly benefited over the last 40 years. Their slice of the pie now is twice what it was 40 years ago. The pie is a circle. If I take twice two slices for myself, somebody is getting less, right? So who are the players who've lost in this process? There's capital, there's labor. So clearly over the last 40 years, there's been this. So the argument might be that the pie is smaller, but there will be some people who will now get a greater slice of the pie. If you if you listen to what's coming out of the White House, they're not even trying to talk the market up, which is unusual, right? Historically, whenever you've had a market crisis, what does the Treasury Secretary do? Come in and soothe fears down and try. Notice that there's almost no attempt on this one. It's almost like they say, look, we're okay with the pie shrinking if we can get a different apportionment of the pie. Long term, I don't know how that'll play out, but that seems to be the inside game in you. So I've started estimating equity risk premiums by day. And I know I'm opening up a Pandora's box because I have to do this every day now. For how long? Until I get to be comfortable again. That might be weeks, months from now. The market closed today, so after the class ends, I'll do the update for today, and I'll have to do this tomorrow and day after. Even the thought of doing this is exhausting, but I have no choice. So this is the start of the graph, and 3 months from now, by May 6th, you will see it start to take form. Let's see if it looks like the COVID graph in terms of rising equity risk premiums, or is it going to level off? But the only way to find out is do it every day. Now, will there be aftershocks? Absolutely. Will the real economy show it? I think that whether there's a recession or not, the economy will slow down. I think inflation fears are going to get lower. Long term, I have no idea. As I said, the pie will get smaller, but who gets what slice will still get played out. It's as much a political fight as it's an economic fight. And doing all of this, I have one piece of advice: stop watching CNBC. I'm supposed to be on tomorrow. Don't watch me, right? I don't want to be on. The only time I actually watch CNBC is in the 4 minutes before I'm on. I have to watch, what's going on so that I'm on camera ready. Because you're going to get the usual suspects. In fact, there are going to be 3 groups of experts that'll show up. So here's a game you can play. It's like a drinking game, but you're not old enough to drink. So drink orange juice or coffee or whatever you have to drink. So watch an expert, say, which group am I going to put that expert in? The first group are what I call the I told you so experts. I hate them. Obnoxious people. So I told you so. The crash was coming. You didn't listen to me. They're going to be out in full force. When you see one of those people, I would look at their history to see how long they've been saying this. And most of them have been saying this for 10 years, 11 years. And then ask yourself a question. If you'd been listening to them all the way through, would you be better off than doing what you've done and actually going through a crash? And I'll wager you're better off doing what you did than going with them. The second group is what I call knee-jerk contrarians. You're going to have people show up and say, you need to buy. Why? Because stocks are down. That's it. That's their entire pitch. It's knee-jerk because anytime something drops, you buy it because you assume that's going to bounce. It's like mean reversion on steroids. And there's a third group where there'll be a lot of hand-wringing. So on the one hand, on the other hand, on the third hand, the fourth hand, the fifth hand. By the time you get to the ninth hand, you completely give up. Because you're not sure whether they're telling you stocks will go up, stocks will go down, or stocks will stay where they are. A lot of market strategies you're going to see in the next few weeks kind of play this role. Yeah. We'll talk about it because in a sense, we'll talk about where to go next because every one of us is saying, what do I do now? Now, if you have no money, of course, you're not even asking that question, right? So that's a different. So that's the first thing to remember. A lot of people have nothing in the market. What do they care whether it's down 30% or up 30%, right? What you choose to do will depend on 3 things. First, it'll depend on how much you need cash and when. If you need cash soon, for what? A surgery, for paying tuition, for buying a home, for God's sakes, don't wait around. Right now, go and put in that sell order, get the cash now, because waiting for the right time is like playing Russian roulette in a crisis like this. So if you need the cash, it's out of your hands. You need to sell now. If you don't need the cash, you have the luxury of waiting. You might not wait. You have the luxury of waiting. Second, it'll depend on what your macro views are and where this will play out. And let's see the three extreme outcomes. So first is a full-scale trade war. Tariffs, counter tariffs, counter tariffs, counter tariffs. It's a worst-case scenario. The second is a partial trade war, where some countries get involved in a trade war and the rest make peace. Little more manageable. The third is that the tariffs actually get pulled off the table. That rumor this morning works out. You get a 90-day pause and then another 90-day pause and then no. I don't think the first and the third are highly probable, but they can happen. I think the second scenario is the one that I think is most likely to unfold. You're saying, but I have to be a macroeconomist to forecast this. No, it's got nothing to do with economics. This is game theory, right? I think if you're a really good poker player, you have a better shot of predicting which of those 3 will come about than an economist, because that's the skill set you need. So cash needs, what do you think about macro views? Finally, it depends on your investment philosophy. Jake, what's your investment philosophy? Buy the dip. Knee-jerk contrarian then, okay? And what is the implicit assumption about markets that leads you to buy the dip? The implicit assumption is markets overreact, right? So anytime you invest in philosophy, it's got to be built upon a belief about how markets make mistakes and how they correct their mistakes. Your philosophy should reflect who you are as a person. So when you buy the debt, what kind of personality do you need to have? Well, not necessarily optimistic. You're probably the kind of kid that was obnoxious right from the start. You did the exact opposite of the rest of the group, right? You're a contrarian. You're the kind of kid that drives teachers crazy from first grade to high school saying, I asked you to do things, you do the exact opposite. You can't be a crowd follower, right? You can't buy the depth if you're a crowd follower because the peer group pressure will keep you from doing it. I'm not saying this is a good thing or a bad thing. There's a personality type you need for your philosophy. You see where this is going, right? If you ask me what's the right investment philosophy, what's the answer to that? It depends on who you are, what kind of person you are, what you believe about markets, and what you do at this time will depend on that philosophy. So you ask me a question about what I'm going to do, I'll tell you what I'm going to do. I'm going to compute the equity risk premium every day because that gives, you know how Winnie the Pooh goes looking for honey? Because it puts him in his happy place. I don't quite have a happy place, but I go looking for the implied equity risk premium becomes my equivalent of honey here. I need to find it, and then I can move on to the next day. So I'm going to do it every day. I'm going to put it up on my webpage. I'll give you a link. So it's through Friday right now, but by later today, it should be through today and then tomorrow. So each day I'll try to keep it up, and I'll keep it going till I say, okay, it's pointless. It's kind of leveled off. Second, I have companies in my portfolio already. On Wednesday, I felt pretty comfortable about those companies, either because they were still undervalued or not overvalued enough for me to sell them. Could that have changed after the trade? Huh? Why? Because the trade war is going to change your earnings, your cash flows, your revenue growth. I have some really bad news for you. For those of you who submitted your DCFs and you did them before Thursday, you might have to, no oops needed. You need to re-examine your story, right? Could your story have changed? If your supply chain runs through, you're a US company, so your supply chain runs through Vietnam, you might want to look at your story and say, what do I do now? Okay. Yes, Sophia. Your question? Yeah. Yeah. See, here's the problem. What's next year's crisis going to be on? We have no idea, right? That's what makes valuation exciting. Right now, we talk about tariffs as if I'll guarantee you, a year from now in teaching the class, tariffs won't be the center of the universe. There'll be something else that will come in. So so I've got to revalue the companies, and perhaps some of them I'll have to get rid of them. Even though the prices dropped, the value might have dropped even more. But there's every danger, creates opportunity, right? Now, remember early in the class, I talked about going where it's darkest. Does it feel really dark right now? No, I know the lights are on, but you know what I'm talking about, right? I mean, it feels really uncertain, really. I mean, and early in the class, I also talked about how great companies can be bad investments. William, how can that happen? How can a great company be a bad investment? Because the price is too high. What happens during a crisis? People sell everything. They're not discriminating. Some of those great companies you've always had on your list that haven't made it now might be viable. A few weeks ago, when I wrote about globalization and disruption, and I valued Tesla. Okay. Ahan, you remember what I told you? I sold Tesla after the election. Do you remember the company I mentioned as a company I would like to buy? I talked about BYD. Brian here is a big fan of BYD. He's been trying to get me to buy BYD right from the start of this class. And I said, I really like the company, but Brian, do you remember why I held back? I said, no, that I'm willing to live because it's politics both ways, it's governments. So I used to not invest in Chinese companies because I said the government is part of my story. But if I buy Tesla, government is part of my story anyway, right? So I'm willing to look past that now. So when I valued BYD 3 weeks ago on the ADR, I came up with a value of like $80 per share. The stock was trading at 100, and I said, I like the company, but I put in a limit buy with good till canceled at $75 then. And I assumed that there was zero chance it would ever get there. You know what? That zero chance is looking like not zero now, right? It's not quite there, but it's starting to move down. I don't know what BYD ended at, the ADR ended at, but I think it was at 88 on Friday. It might be all I know. 80.72. We're getting really close. One more day like last Friday, I'm there, right? So, and you know why I made it a limit buy? Because if you have to buy it, you will never pull the trigger, right? So BYD and Mercado Libre, which is the stock I put up as my stock for this week, take a look at it. Great company, overvalued last week, but could become undervalued this week. So I will see you on Wednesday. Mercado is portfolio, if you do, you should buy just when it gets done, right? If you have a lot of opportunities, then you can pick and choose. Anytime you put in a margin of safety, it's because you have too many opportunities and too little money. So that's really what portfolio.
And typically, like, what are the catalysts that you look for when you're seeing, when you're kind of determining whether a